The effective tax rate, it was way off.
So what's the plan?
We're bringing in BDO. The partner's already on it.
People who know BDO.
Hi, everybody. Welcome to On the Money. I'm Maria Bartiromo. The Fed speaks, the markets tremble. What the Fed said, what it meant, and is the market's winning streak over?
The hype over sequestration is a joke.
The self-imposed spending cuts of the sequester are just days away. But how much do they really matter? What a hedge fund legend says is an even bigger problem we're facing. And everything old is new again. How one major city wants to put those old phone booths back to work. And how high tech can make a big city run better and work smoother. On the Money begins right now.
This is America's #1 financial news program, On the Money. Now, Maria Bartiromo.
Here's a look at what's making news as we head into a new week on the money. The Fed spoke, the market shook. The Federal Reserve releasing minutes this week showing that it is considering a slowdown of the bond buying program before it hits the target of 6.5% unemployment. Fed members were concerned about the possibility of inflation and of expanding its balance sheet even further. The markets did not like that at all. The index is having one of the worst days of the year on Wednesday, the Dow falling triple digits. The markets, though, rebounded later in the week. Office Depot and Office Max will be walking down the merger aisle, the two office supply companies announcing an all-stock merger to create a company worth about $1.25 billion. It will likely be able to cut costs and increase sales by closing underperforming stores. Earnings season is almost at a close, but some important companies are still reporting. Dell beat analysts' expectations in what could be the last report before going private, as did Hewlett-Packard and Walmart. Insurance giant AIG came in ahead of as well. Gas prices are at a 4-month high today. AAA reporting national prices have risen 43% over that period. Prices usually go up headed into the spring driving season, and higher crude oil prices plus refinery shutdowns for maintenance are adding to the increase. We've had nervous markets, a smidge of Fed speak, and the sequester is looming. What's next for the markets and the economy? Joining me now are two Bobs. Bob Dahl, Nuveen Asset Management's chief equity strategist, and former Dallas Federal Reserve President Bob McTier. Gentlemen, good to have you on the program. Thanks for joining us.
Thank you.
Thank you, Maria. Good to see you both. Bob Dahl, let me kick this off with you in the markets. Of course, they've been on a tear lately, closing at 5-year highs, but they were spooked this week by the minutes from the Federal Reserve, which said or suggested they may stop the bond buying program or begin to wind it down at some point. Do you think this is a hiccup or the beginning of a downturn for the markets?
Look, I think the market has looked tired over the last couple of weeks, and this is just another reason. Look, anyone who thought the Fed would buy bonds forever probably hasn't been listening, reading, or thinking rationally. I think all they're doing is saying, this won't be forever, but for now, they're still at it.
Bob McTier, what would be the right strategy here? I mean, we all know that the economy has been slowly but surely coming back, and most people will attribute that to the Federal Reserve stimulus.
Well, it'll be good when they can eventually ease up on that and abandon it, but I don't expect that to happen during this year. I think we can count on the Fed's significant support throughout this year.
How would you characterize the economy right now, Bob McTier?
Well, it's vulnerable and it's weak. I think the fourth quarter negative number will be revised up into a slight positive. I think the first half of this year will suffer a little bit from the tax increases and possibly the spending reductions that are scheduled next week. But I see no reason that it won't take off and be much healthier in the second half of the year.
So, Bob Dahl, we're seeing the return of deal making in the markets. That's also one way companies have been using their cash. You saw Office Depot, Office Max. Last week, Warren Buffett's Berkshire Hathaway and Heinz, US Air and American Airlines. A lot of deal flow. What do you think that says about the markets and about where we are?
Well, I think it's a measure that confidence is going from very low levels to less low levels. Look, we know there's a lot of cash out there. And if you don't have cash, you can borrow it, but not everybody can. If you're able to borrow it, it's pretty cheap. Stock prices are not expensive. Companies are struggling to grow organically, so let's try inorganic. I think we'll see a bunch more of it, Maria.
So, Bob McTier, what about that? I mean, Ben Bernanke is testifying before the Senate next week. What can he say at this point? What are you expecting from that testimony?
Well, I think he needs to give a pep talk to the fiscal policymakers that there's more than one game that can be played here, and fiscal policy has been AWOL. I think the really important thing is to start working on the entitlement programs. It's not so important what happens to discretionary spending right now, but we've got to start doing something to reduce the entitlement spending in the outcoming years.
Everybody says it. I mean, this program alone, you've got so many people saying we've got to get to the entitlements. And the sequestration, which takes effect on Friday, March 1st, it doesn't even hit entitlements.
It's a bad idea whose time has probably come, because we don't seem to have anything else on the plate right now. I don't think that's going to be as serious as people are fearing it will be. As far as what's wrong, I think gerrymandering of congressional districts play a large role in this, because most of our congressmen are very secure in their jobs, and they can afford to take extreme positions and not be willing to compromise.
So in the face of all of this, Bob Dahl, how do you want to invest? What sectors do you like? Where should investors be exposed? And do you want to lighten up here?
Well, despite the government, and Bob had it all right, including the gerrymandering point, I think we're in an environment where the U.S. economy in the second half will be stronger than the first half. Emerging markets are grabbing hold and no longer declining. So the world is healing. It's becoming less bad, if I can put it that way. And as a result, I want cyclicals in my portfolio, some industrials, some technology. I'll take an energy company or material here or there. And then in the defensive area, I still like healthcare. They're the kinds of names, free cash flow oriented, that I think can win.
All right, we'll leave it there. Gentlemen, great to have you on the program. We so appreciate your time today.
Thanks, Maria.
We'll see you soon. Bob Dahl, Bob McTeer joining me. Up next, we're on the money. A legendary hedge fund manager speaks out about entitlements and America's future. And then the clock is ticking. The March 1st sequester deadline draws near. What all of Washington is waiting for when it comes to cutting spending and the road ahead. Plus, later, technology may be where the jobs are, what the sector's booming business means for local governments. I'll talk to New York's top tech geek. Legendary former hedge fund manager Stanley Druckenmiller and education reformer Jeff Canada teamed up for an op-ed to raise awareness and a warning about what they say is a much bigger problem than sequestration, and that is the debt. This week, I spoke to them both about the bond market, unintended consequences, and the issue of entitlements. It's all in this week's conversation.
The implications that we are going to spend money that ought to go towards education, it ought to go to their retirement, it ought to go to research and development. We're going to spend that money now on Medicare, Medicaid, and Social Security.
They totally take a pass on entitlements, which is the problem.
No accountability.
And then the president comes out and says, I'm not going to do this on the back of seniors. Well, those seniors, as we put on in the article, are all taking out more than they put in. You know, the bond market is a funny thing. In Greece, the bond market was perfectly fine until February of 2010. Not moving, not doing anything, and then in 2 weeks, it was over. When we were at 10 trillion and now we're at 16 trillion, the interest cost on the 16 trillion is 20% less than it was on the 10 trillion. Now, come on, do you think that's sustainable? So, if you normalize interest rates, I'm not talking about a spike, just normalize where they were before QE, and took them to 5.7% federal funding costs of this debt, that's $500 billion a year in interest expense that goes out the door. We're having a heart attack over an $85 billion sequester when we can lose $500 billion just if you normalize. But the way markets work, Maria, if and when this were to happen, you don't normalize, you keep going, because the market figures out that you now have a credit problem, which is exactly what's happened in the foreign nations.
Do you think we will see a blow up in this market this year when people start realizing the effects?
The biggest unintended consequence of the Fed right now is Congress is not getting the market signal we talked about in the article. So you can scream all you want about Congress and the president being clowns. I can't think of any political system anywhere where they acted without interest rates going up. When did the Greece Act? When their bond market blew up. When did Spain Act? When the bond market blew up.
Right.
What was Clinton's great line about Rubin? You mean the effing bond market is in control of this situation? Remember that?
Right.
So by doing what they're doing, the politicians have no incentive. And then but the market is a very fickle and violent thing, and one day it goes like that.
And the clock is ticking closer to the sequester deadline. The spending cuts of roughly $85 billion set to go into effect Friday, March 1st. Joining me now are two co-chairs of the Campaign to Fix the Debt, founded by former Senator Alan Simpson and former White House Chief of Staff Erskine Bowles of the Deficit Reduction Commission. Judd Gregg is former senator and governor from New Hampshire, and Ed Rendell is the former governor of Pennsylvania and former chair of the Democratic Party. Gentlemen, good to see you. Thanks for joining us.
Thanks, Maria.
So what do you think? Assuming the sequester takes effect, kicks in, what is the immediate impact? Ed Rendell.
Well, Maria, I think in the very short term, there'll be limited impact. But as the days go on, you're going to see people laid off in the federal government. You're going to see defense workers laid off at their jobs. You're going to see the federal bureaucracy, if not grind to a halt, be severely limited in its ability to protect us and keep things moving. It's going to be a real difficult time, and it's happening at the worst time, when the economy took a hit the last quarter, when it's vulnerable, when we need to be seeing investments in the economy. It's a bad thing for the nation. The only thing almost as bad would be if we kick the can down the road and do some
nothing.
Temporary little settlement.
Judd Gregg, how do you see it?
I actually see it the same way that Governor Rendell sees it, which is that it is a very severe way to get spending under control and not a very good one from a standpoint of public policy. But it was set up for one purpose, and that was to force the administration and the Congress to come to an agreement so the can wouldn't be kicked down the road. And it really represents a true opportunity for the two parties to get together here and replace the sequester, which is a $1.2 trillion across-the-board discretionary cut, with the changes that have to be made in entitlement programs to get our fiscal house in order over the long run. And that's exactly what should be done. That's the way you relieve the pressure of the sequester. And that was the concept behind creating the sequester in the first place, to get something big done.
How come something big is not getting done, though? I mean, even, this Friday's cuts, they don't even touch entitlements. It's just sort of throwing darts at the defense industry.
Well, I think the problem is that neither side is willing to stake out painful positions. The president says he's for change CPI, which is a good start. If he wants to get some additional revenues, he's got to be for significant entitlement reductions that will, in fact, have a long-term effect, not just in the first 10 years, but in the second 10 years as well. It's a good start, but he hasn't talked to the Democrats in the House and the Senate, and he hasn't gotten them to buy in yet. And that's one of the things that executive leadership has to undertake.
Ed's absolutely right. The president actually did put a very significant item on the table in the CPI. And the importance of the CPI isn't the first 10 years. The importance is that it multiplies very quickly, compounds very quickly. And by the third 10-year period, you're talking trillions of dollars of savings. But he hasn't led in the sense that he hasn't given the political cover that members of his party need in order to vote for something like that. And what you need is a package here that both sides can come to the table on and agree on. The majority of it's going to have to come on the spending side, but there'll probably have to be some revenues too through tax reform. And the two sides just have to get mature about this and face up to it. And my concern is the window's closing fast on the opportunity to do something, not only politically, but substantively. If the Fed starts to move on interest rates and we start to see interest rates go up, you can see a radical increase in the cost of paying the deficit, paying the debt service for the federal government, which will blow a huge hole in our capacity to get our deficit under control.
Right. What's the danger to all these cuts? I mean, when you look at the potential of $1.2 trillion in cuts to defense spending through 2021, what's the impact? Is there a danger in terms of feeling the worst of it?
There's a huge danger if it were actually carried forward because it is extremely arbitrary and the discretionary side of the ledger has already taken a $900 billion cut as a result of the Budget Control Act of 2011. And the problem is not on the discretionary side of the ledger. The problem is on the entitlement side of the ledger. The danger is that the Congress will just focus on discretionary spending and not focus on entitlement spending, and the markets and everybody else will know that that's a fake attempt to try to get our house in order, our fiscal house in order, and there will be a financial reaction which will result from it.
Yeah. So Governor Rendell, I mean, if the problem is in entitlements, that's where much of the spending of the government is going. Everybody knows that. The average guy and gal out there buys into it. They know these programs have to be changed. How come the president and Congress won't do it?
Well, because they're afraid to go first. It's like who's going to stick their toe in the water first. it's a little bad news because you tell change CPI is going to mean a reduction in benefits. I think it's a relatively slight reduction. And as Judge said, the payoff is big in the second 10 and the third 10 years, but nobody wants to be the bearer of bad tidings. But I think that's where the president has to step up and lead. And he's got to not only work with the Republicans to get them to sign on, and I think they will sign on, but to get the majority of Democrats. You're not going to get all Democrats on change CPI or raising the age limit, but you got to go to Nancy and say, Nancy, Harry, this is what I need. This is what the country needs. Put your personal preferences aside. Let's make this deal, because if we do this, we believe the economy will absolutely take off.
All right, we will leave it there. Gentlemen, good to have you on the program. Thanks so much.
Thanks, Maria.
We appreciate it. We'll see you soon, Senator Judd Gregg and Governor Ed Rendell. Up next, we're on the money, reinventing payphones in a smartphone world, harnessing technology to make New York run better and run richer, what it could mean for your city. And tell us what you think about the show. Go to Facebook, look for Maria Bartiromo. Well, from Silicon Valley to Silicon Alley, the technology sector is driving much of the vibrancy in today's economy and jobs market. New York Mayor Michael Bloomberg announcing this week a new initiative to spur and keep homegrown startups with a series of incentives to businesses that are made in New York. Rachel Hout is New York City's Chief Digital Officer. Rachel, it's good to have you on the program.
Thank you so much for having me.
Thanks for being here. So, Made in New York. This is a branded campaign for film and television produced in New York. This week, the city announced expanding it to technology and digital companies. What's this all about? What's the strategy?
Absolutely. Well, we've seen over the past several years that the tech community in New York City has truly grown and our tech sector has arrived. And what's amazing is we realized we have over 900 tech companies here in New York City that are 75% or more developed in the 5 boroughs. Beyond that, we have another 1,000 who are based here. So there are thousands and thousands of jobs. Over 120,000 people are working in the sector. So we thought it's important that the world is aware of this. We launched We Are Made in New York, which is a website at wearemadeinny.com. And it's a one-stop shop for all the programs and resources that you need to participate in the new tech ecosystem and, crucially, find a job.
Talk to us about this boom in the technology sector that you're seeing. What does it mean in terms of economic impact? Certainly the local economic impact has to be very strong.
Absolutely. Well, one of the hallmarks of the Bloomberg administration has been to diversify the economy. And also, one of the advantages to being in New York City is that we do have so many leading industries here, which are still very powerful: the media industry, fashion, finance, and real estate. And a lot of these are the systems that are driving the business models of the tech sector and of the next generation of startups. So it makes sense that the companies are based here. 2012 was a fantastic year for tech in New York City. There were over $8.3 billion worth of acquisitions in our sector.
Tell me about your position, engaging New Yorkers in the community in this digital and information-led era. How does your role fit in the urban government?
Absolutely.
I mean, you had 2 hurricanes hit.
Our focus is to support innovation inside government and outside government. And day to day, what this means is we're making it easier to navigate government digitally. And we are supporting New York City's tech sector. And that also brings in a lot of public-private partnerships. So, for example, during Hurricane Sandy, social media became a crucial line of communication for how we reached people, especially in situations where perhaps you just have enough of a signal to get that tweet or see that last Facebook update. We were able to reach millions of people, and we had partners like Twitter step up to the plate and donate $1,000 worth of promoted tweets. We had Google helping us build an interactive map that showed where shelters were located. So it was truly a group effort, and the tech community played a great role in that as well.
Very important. I love your upcoming project of revamping phone booths in New York City. We all remember those phone booths, and we wanted to make a call. They're not used as often as they used to be in the era of mobility. How can we recreate what's already there to take it up to the next level in terms of technology?
Exactly. We're so excited about this. So we have the Reinvent Payphones Design Challenge. And what that does is invites ideas and innovations from the public to reimagine. We've got over 11,000 payphones. At the height, about 5 or 6 years ago, we were seeing 30 million calls a year, and now there are about 5 million calls a year. And at the same time, we know that during situations like Hurricane Sandy, they were crucial because they keep power and they can connect people in an emergency. So here we're saying we know people are using payphones less because they've all got mobile phones, and that's increasing day to day. What can these look like? And some of the ideas we've seen so far are Wi-Fi hotspots, charging stations. The ideas really are limitless, and the submissions closed on Monday. We had over 125, so now the challenge is narrowing it down for a big demo day that's coming up soon.
Rachel, good to have you on the program.
Thank you so much for having me.
We'll be watching your developments for sure. Rachel Haut joining us. Up next, a look at the news this upcoming week that will have an impact on the money. As we take a break, take a look at how the stock market ended the week. And for more On the Money, check out the website, otm.cnbc.com. And I hope you'll follow me on Twitter and on Google+. Look for @Maria Bartiromo. Now, a look at what's coming up in the week ahead that may move the markets and impact your money this week. Earnings are out from retailers Home Depot, Best Buy, Macy's, Saks, and daily deal site Groupon. On Tuesday, 2 reports on the housing sector are out. The S&P Case-Shiller Homes Price Index will be released, as well the new homes sold in the month of January. Also Tuesday, Federal Reserve Chairman Ben Bernanke will begin 2 days of testimony before the Senate Banking Committee. On Thursday, the second estimate of fourth quarter gross domestic product is out, sometimes a market mover. And Friday is March 1st. We will get auto sales for the month of February, as well as data on Americans' personal income and spending. That'll do it for us for today. Thank you so much for being with me. And next week, my guest, recording executive Clive Davis, a legend in the music industry. Each week, keep it right here where we are on the money. Have a great week, everybody. I'll see you again next weekend.